Hello and welcome to another session of the My Solo 401k Financial Daily YouTube Webinar Series. Let's discuss how to report solo 401k contributions on your tax return. Today, we're going to focus specifically on a business that is taxed as a C corporation, could be an LLC taxed as a C corporation, or an entity that's otherwise filing an 1120. Thank you so much for joining. As always, today's presentation is being provided for educational purposes only, should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. If you are on YouTube, it's great if you subscribe. That way you get notifications of when we go live. We go live twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern. We come back in the afternoon. This is the afternoon session at 1 p.m. Pacific, 4 p.m. Eastern. You subscribe, hit the notifications bell. You'll get the notifications. You can jump on, ask questions. We also host a lot of great deep dive content, not just more abbreviated content like today, but deeper content. For example, on the docket is going to be the magic number, right? Like how much income one needs to be able to maximize contributions. So if you subscribe, you'll get the notifications when we go live with that session. And then, of course, the daily sessions. Other great resources are our community. We've got over 30,000 members on our community. We have vibrant forums. We have a library of videos and webinars. We have the industry's first AI chatbot you can access at solo401k.ai. It's a great way to quickly find answers and find resources. So let's dive into today's content, which again is how to report solo 401k contributions on your tax return, specifically for a business taxed as a C-corp or an LLC taxed as a C-corp, a business filing 1120. So I think it's helpful to understand that a solo 401k has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because as a self-employed individual, the individual is eligible to make different types of contributions. So it's not just like a 401k that someone might have at a day job where they can only make employee contributions and maybe the employer will make contributions or maybe not, right? With the solo 401k, that's for a self-employed individual. So that individual is both the employee and the employer. So if they have a plan like ours that allows it, they can make both employee as well as employer contributions. And then on top of that, our plan not only allows for pre-tax contributions, which has the benefit of reducing one's income now, in other words, for the year for which the contribution is made, but it also allows for Roth or even mega backdoor Roth contributions, where you have the potential for tax-free growth. With a mega backdoor Roth contribution, the individual can contribute, for example, up to $70,000 for 2025, or even more if they're age 50 or older, because of the ability to make catch-up contributions, where those funds will end up in a Roth account, where you have that potential for tax-free growth. So answering the question of how to report solo 401k contributions on your tax return is going to depend, number one, on how the business is taxed. So today, again, we want to focus on businesses that are taxed as a C-corp, but also depends on the type of contribution that the individual is referring to, the type of contribution that they're making. How the type of contribution they're making plus how the business is taxed will dictate how to report that contribution. So let's go through the different buckets. So let's start out with employee contributions, then we'll turn to employer contributions. So when one's business is taxed as a C corporation, the ability to contribute to the plan is based off of the W-2 wages that the individual receives. So if that person is making employee contributions, those contributions may be reported on the W-2. For example, our plan allows for pre-tax employee contributions. So when you make a pre-tax contribution, the individual is reducing their taxable income now. In other words, for the year for which the contribution is made. And the way that reduces the person's income is it reduces the income that's reported in box 1 of the W-2. The amount in box 1 is the amount of taxable income that's carried over to that top of your 1040. So if that individual can reduce the amount of income in box 1, that'll reduce the amount of taxable income, because that'll reduce the amount of income that's going to be carried over to the 1040. So for example, let's assume the individual is under 50 years of age. Let's assume that they have $100,000 of W-2 wages. Let's assume that they don't make contributions to another plan like a day job plan. And for 2025, they contribute 100% of their wages up to $23,500. They can contribute up to 100% of their wages up to $23,500. So let's assume that that individual chooses to make that $23,500 employee contribution, and they choose to make that as a pre-tax contribution. Well, that means the amount that's reported in box 1 is going to be reduced by $23,500. So instead of $100,000 in box 1, that'll be $76,500. So that'll reduce the amount of income that's carried over to their 1040. It'll be made on a pre-tax basis. It'll reduce their taxable income. So instead of reporting $23,500 in box 1, it'll be reduced, and instead it's going to be reported over in box 12 of their W-2 using code D with retirement plan field checked in box 13. Now, if the person has a plan like ours that allows it, they can make employee contributions as Roth contributions. Now, when you make a Roth contribution, the individual is making that contribution on an after-tax basis. So it doesn't reduce their taxable income now, in other words, for the year for which the contribution is being made. Instead, it has the potential for tax-free growth. So any gains on the investments made once the money's in that Roth Solo 401k account will be tax deferred. And if when the person withdraws the money from their Roth Solo 401k, if they withdraw the money as a qualified Roth distribution, meaning they've had the account for at least 5 years and they're age 59 and a half or older, they'll be able to take out those gains totally tax-free. So from a reporting perspective, that let's assume instead of making that $23,500 employee contribution as a pre-tax contribution, let's assume that the person chooses to make that as a Roth contribution. So it's made on an after-tax basis, so it's not going to reduce the amount of income in box 1. So box 1 would still show $100,000. The person would still carry over $100,000 to the top of their 1040. So, but it still needs to be reported on the W-2. So it's still reported in box 12, but instead of code D, the W-2 instructions provide that you use code AA, and then again, you still check the retirement plan field in box 13. Now, the third type of employee contribution that the individual might be making is voluntary after-tax contributions. So you need to have a plan like ours that allows for making voluntary after-tax contributions. And the reason that one would make those voluntary after-tax contributions is because they want to make mega backdoor Roth contributions. Because when you make a voluntary after-tax contribution, if you have a plan like ours that allows that after-tax contribution, as well as that in-service, either transfer to a Roth Solo 401k or transfer to a Roth IRA, ultimately those funds will end up in a Roth account where they have that potential for tax-free growth. Now, from a reporting perspective, it's just like a Roth contribution in the sense that it's made on an after-tax basis. So it's not going to reduce box 1, right? So, but it's unlike the Roth employee contribution, which does need to be reported in box 12 using code AA. Per those W-2 instructions, voluntary after-tax contributions don't have to be reported on the W-2. In other words, it's optional. Now, if the individual chooses to report those after-tax contributions on the W-2, they may be reported in box 14 of the W-2. So that's how you report employee contributions that are made to a solo 401k. Now let's turn to the other type of contribution, which is employer contributions. Remember, for a self-employed person, they're both the employee and the employer, so they can make both employee as well as employer contributions. So in terms of how you report those employer contributions, well, it needs to be reported as tax deductible on the employer's tax return. So that's going to be the 1120 in the case of a business taxed as a C corporation, specifically line 23. Now, since Secure Act 2.0, employer contributions can be made as both pre-tax, so that reduces the taxable income for the year for which the contribution is being made, and or if you have a plan like ours that allows it, those employer contributions could be made as Roth contributions. Now, if they're going to be made as Roth contributions per IRS Notice 2024-2, it still is tax deductible on the employer's return for the year for which the contribution is being made. But it isn't a Roth contribution, so it still needs to ultimately be made on an after-tax basis. So it becomes taxable to the employee for the year for which the contribution is being deposited. And those might be different years because the contribution deadline for a solo 401k is the business tax return deadline, including any timely filed extension. So that's why it's very common, for example, that at this time of year, customers are making contributions for the prior year because they have up until that business tax return deadline, including extension. For example, for a business tax as a C corporation, that's April 15th or October 15th if they file the timely extension. So someone might have set up a plan last year or even in a prior year. They're now making that employer contribution for 2024, and they're making it on a Roth basis. So it's being deposited into that Roth account. So per IRS Notice 2024-2, that'll still be tax deductible on the employer's 2024 return. In other words, on the 2024 Form 1120 over in line 23, to reduce the taxable income to the employer for 2024. But then it'll be taxable to the employee for the year of the deposit, which is here in 2025. So that means that a 1099-R will need to be issued to the employee so that increases the employee's taxable income for 2025. Now, we handled that Form 1099-R preparation as an optional free service. In other words, no additional charge for customers who request it in a timely fashion. So there's a form on our website that customers use to let us know about those employer Roth contributions. That's how we capture the information so that we can add the plan to the queue to prepare the 1099-R. So that answers the question for the other type of contribution in terms of that question of how to report solo 401k contributions on your tax return for a business that's taxed as a C-corp, could be an LLC taxed as a C-corp, or a business that's otherwise filing Form 1120. All right, well, hopefully that helps. We appreciate all the good participation. If you found this presentation to be helpful today, if you could please like the video on the YouTube channel, that'll help us get the word out, as well as subscribe. That'll give you a chance to get notifications of when we go live. We go live twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern, back again at 1 p.m. Pacific, 4 p.m. Eastern. Here's our channel. You can see that we post all our videos on there. Another way to register for the webinars is if you go to mysolo401k.net/webinar, you'll always find the schedule there. And if you enter your email address, then you'll get an email after we're done with a link to the recording. All right, well, we'll give it a moment to see if any questions come across. Otherwise, thank you so much for the good participation. We do appreciate it. Again, please like, please subscribe. Please continue to engage. You're more than welcome to come to our community. It's not just for customers. mysolo401k.net/my-community. We have over 30,000 members on there. There's a vibrant forums, library of videos and webinars. There's a lot of great ways to learn and to share the knowledge. All right, until next time, everyone, take care.